Hi, folks. It's Charles Thomas from Intrepid Eagle Finance. I'm here to share some commentary about what happened in the fourth quarter in the financial markets and the economy. We'll jump right in with some good things that happened and then some areas we want to keep an eye on for caution. On the positive end, 2023 was a very strong year for investor returns. By virtually every measure, even with the noise, this was an extremely positive time to be an investor. When we can look at inflation, inflation continues to recede from the peaks, not quite back to normal yet, but it's off the highest levels it's been. That continues to be positive. When we look at bonds, also known as fixed income securities, there's more income there than there has been in a long time. That's another thing that's positive. When we look out there at places where we want to be a little more cautious, although the biggest stocks in the US, the large cap stocks, did very well, that's largely being driven by a handful, about 7 stocks. We'll talk about that more in a moment. When we look at on the risk side of things, what's going on in the world with headlines, there's a lot of geopolitical risk. We're in an election year that's got some uncertainty around it. A lot of things in the news out there. And then lastly, on the inflation front, it's unclear if inflation is going to go back to what it is more normal, if that means anything. Although it's come off its highs, we're still not back to a point to where we would consider inflation to be normal. It's unclear if we're going to trend in the right direction or what's going to happen with that. So time will tell there. Let's talk about some numbers for 2023 to get an idea of what actually happened. The first number I want to give you is 0. And that's how many recessions we had last year. And that's significant because we were widely expected to have a recession in 2023. Now, what I'll point out is that a recession is a technical term that is from economists and something that they put the definition of around for. So I would keep that in check and keep that in perspective. But if we look at that, we had no recessions in 2023 in a year where it was widely expected that we would. That was very significant. The next number I want to give you is 1. And that has to do with ratings agencies. There's 3 of them that are out there. And what they do is those rating agencies essentially give the equivalent of a credit score to companies and governments that issue bonds. And they tell you about how creditworthy or how likely they are to pay their bills they are. There's a variety of ratings they can give. But when it comes to the United States government, there's only one ratings agency that's giving the United States government a AAA rating, their best rating. The other 2 are giving less than that. That remains something that is significant. That is still a first. That was not the case for a long time. For many, many years, most all of our lifetimes, the United States government always had that highest credit rating from everyone. It was just a foregone conclusion. Now it's gone down a little bit, except for the one ratings agency, and that's Moody's. 22%, that was the actual return for global stocks last year. Very strong, no matter what your basis of comparison is. When we look at 26%, that was what the S&P 500 is. When we look at just US, also very positive. When we look out at the Federal Reserve's rates, 5.25% to 5.5% was the rates that we landed on last July. As part of this campaign, the Federal Reserve has been doing to try to counteract inflation as they've been raising rates very methodically over the last couple of years. And they're trying to get that to that level to tame inflation. Right now, where we're at with rates, it's the highest level we've been since 2001, if you can believe that. And where they landed with rates in the summertime, we're essentially in the same place right now. So once we got to that point, they've decided since then to take a pause. We'll see if that lasts. 3.1%. That was the number from November for the Consumer Price Index called CPI. It's one of the most referenced measures of inflation. Now, the reason why that was significant is that's in comparison to the high of inflation we hit during the middle of 2022. That was about 9%, which is just shockingly high. 3%, although it's a big improvement, is still very far above the normal 2% that the Federal Reserve sets as their target for that. The other thing I would tell you that the consumer price index, although it gets referenced a lot, is ultimately a little bit of a deceiving and flawed measure in my estimation, because it measures a lot of things for inflation, but it leaves out two very important components. It does not measure the price of energy or food. And I think you would all agree with me that the price of energy and food is pretty darn important. So anytime you see the CPI number or see that on the news, just keep that in mind. It's interesting and it is important, but there are some pieces of that that are not represented in that number. So just keep that in perspective. And then lastly, 4.98%. That's where the 10-year United States Treasury closed at in the fall of 23. And the reason why that's significant is we have to go all the way back to the summer of 2007 to get to the point when it was at the same level. It's been that long since rates have been at the same levels. Just pretty wild to think about, because we had all those years of very low or zero rates. We've just now come back around to the level we were at in the 2000s. Pretty wild to think about. Now, although 2023 was extremely positive from an investment return standpoint, it was not an entirely smooth ride. And that's what I wanted to show on this chart here. Throughout the year, you can see the Fed's pace and rate increases. They slowed until they paused later in the year. They get to see in the second quarter, we had folks still saying, yes, there's going to be a recession. And all throughout that, you've got the S&P 500 getting new highs, new lows throughout various parts of the year. And that's where it can be so difficult to accurately predict in the short term what's going to happen. And this chart, it shows what we call a consensus estimate, where they take a bunch of different estimates about the stock market and put it together about what analysts think the S&P 500 is going to be. And this shows the estimate through November of last year and the preceding 5 years. And these results are not very favorable if you're a forecaster. For the 5 completed years, the estimation error ranged anywhere between being 26% too high and 21% too low. And then on average, they were off by about 18%. Pretty far off. And we will look more specifically at some individual places. And I listed some specific firms on here, and I'm not doing that to pick on anybody. But the point I want to make here is that each of the firms I listed here got it wrong. And they got it wrong with having access to some of the best information, the best resources, and the smartest people that work in economic forecasting. Each of these firms had lower forecasts versus what actually occurred. And they were off anywhere from 8% to about 22%. So in other words, forecasting, it makes for interesting debate, interesting conversation. But this is why I advocate for not basing investment strategy off of short-term forecasts. And yes, I do consider 1 year out to be a short-term forecast. Now, speaking about wrong forecasts, there was a broad consensus at the end of 22 that there would be a recession in 2023. And that was a recession that didn't occur. In fact, 2023 was somewhat of an odd year in that we witnessed a continued decrease in inflation without the corresponding rise in unemployment that we usually see that goes along with that. That's a very odd thing for those two things to occur like that, one without the other. Whether it will remain that way in the long term, we'll have to wait and see. But so far in the last 12 months, that was a positive thing. And we've been talking about the last year about when the Federal Reserve takes action, there's essentially 3 things we're watching. We're watching the pace, pause, and pivot. So the pace at which they have raised rates, when they decide to pause and stop raising, and eventually the pivot, where they decide to lower rates. Now, we know what happened in 2022 with inflation. If we look back to the second quarter of 2023, we saw the Fed implement their last rate increase, at least up to this point, and they moved rates up by about 0.25% in July. And then the Fed hit the pause button in the summertime, and the Fed rate remains around 5.25 to 5.5%, and that's the range they set during the summertime. Now, what the Fed has said is that they're going to keep an eye on data, and any future changes will be in response to inflation. They've continued to promote this idea that even though inflation has moderated from the highs, there's still a long way to get to that 2% target that they keep for the long term. And there's no guarantees, as we all know. So in other words, it could be a while before the Fed hits that pivot and lowers rates. Time will tell. Now, if we look at some specific parts of the financial markets, first we'll look at the global bond returns. There was a big decline in U.S. bond yields during the fourth quarter, and that drove returns. So in particular, the intermediate and the long-term parts of the curve, they saw their yields fall more dramatically than the shorter ends of the curve. If you look at the fourth quarter returns, it was a major driver of returns overall. So I'll give you an example. The 5 to 10 year corporate bonds had a fourth quarter return of 8.1%, but a return for the overall 2023 was 8.8%. That's how much of it came in the fourth quarter. If we look at the global bonds outside the US, they also had a very strong quarter with strong year at about 8.3%. Very strong things there. When we look at global yields, then we have a few stories we can tell here. For example, if you look at the chart in the top left, tells a few things. For one, you can see rate levels are today versus the zero levels we had just a few short years ago. So it's important for us now because what we're seeing is investors are receiving actual income from their bonds. And that was not the case for quite a while. You can also see how the curve is at the end of 2023. It's below the level where it was in September of last year. Gives you an indication of just how strong the fourth quarter was for bonds and how well they did. Again, if you look at the curve from the end of last year, it's very similar to the curve from the previous year. It doesn't show how much change actually occurred through the year. And finally, I'll just mention the curve is still in what we call inverted, meaning the short-term yields are higher versus the long-term yields. So if you look at the chart on the top right, you can see how the various countries line up on that. And the curves are shaped differently with different levels of rates. And I think this is just another thing that supports why we think diversification is so important. Looking at the US stock market, virtually every measure we used to measure the US stock market was positive. And that was for the fourth quarter, and that was for the year as well. When we looked at the biggest stocks, those large cap growth stocks, they had the highest annual return, but that return came from just a few companies. It was concentrated there. And that's become known in many circles as the Magnificent Seven, because it's 7 stocks that have driven that. And I want to tell you a little bit about, just to put this in perspective. So S&P 500 did very well for the year. It was up over 26%. Now, the majority of that return, though, that came from those 7 stocks that I mentioned. Those had a ridiculously strong 2023. If we look just at that 7, they were up over 76%. Now, we compare that to the other 493 stocks in the S&P 500. They were up about 13.7%. Now, we love when things go up, but the point I want to drive home with that is, although it's a very healthy stock market, we would love to see it be healthier in the sense that that return is more spread out among a broader and bigger number of companies than just the 7. So we'll keep an eye on that. And just to give you an idea of the scale at which those 7 companies are working on, if we go and add up the value of all their stocks together and stack that together, those 7 companies, to get that equivalent size, I would have to take the entire stock market of Japan, and the entire stock market of Canada, and the entire stock market of the United Kingdom, add those together to get the equivalent size of just these 7 companies in the US. That's how big they are in comparison to just this massive scale they work on. That's the importance that they've grown to. When we look outside of the US, similar to the US, the non-US stock returns that were quite strong for the fourth quarter and for the year. The international large caps outperformed their small cap peers, just like in the US. Now, what was different was, unlike the S&P 500 we just talked about, where a lot of the return is concentrated at the top, internationally, we saw much more equal footing that was much more broadly distributed across various companies, and that was a little bit more distributed across there and not so concentrated. Speaking about the strength of the US dollar, so what we're looking at here, it's an index that the Wall Street Journal does. It compares the US dollar to about 16 different foreign currencies, and we get to see how strong the dollar is over time. Now, just as a reminder, a rising dollar, it's good for us as consumers because it makes foreign goods cheaper to purchase, but it's not as helpful if you're an owner of a non-dollar investment, like a foreign stock. So if you say that a little bit differently, a strong dollar can hurt international investment returns. A strong dollar also hurts U.S. exports, and that can affect depending on the type of businesses that are out there. Now, I'll point out on the top chart here, it shows about the last 20 years for what things look like. And then that bottom chart is the last 3 months. The dollar fell over the last quarter, but overall, we're still at a very high level. So another way to look at that is the dollar is about as strong as it has been in the last 20 years. The 2023, when we look at just that year, US dollar had periods of strength and weakness relative to the other currencies throughout the year. And it ultimately went down slightly for the year, but we're still at a very high level compared to where we've been over the last 2 decades. Now, one question I do get sometimes is, why should you have non-US stocks when US stocks have done so well relatively over the last 10 years or so? Well, one of those reasons is because of diversification. While US stocks have outperformed more recently, that has not always been the case. And you only have to go back to the 2000s to find the last period where international stocks outperformed and did better. Now, we have short memories on these things. It was not that long ago where we had a lost decade where the S&P 500 had almost no return. International stocks did not have that same problem over that same period. When you look at that last slide with the US dollar, it's also where it's strong against other currencies. If the dollar were to weaken, it would be a tailwind. It would be a help for non-US stocks. And when you look at this chart here, I just want to point out, so not only are most non-US stocks currently, they're undervalued versus their last quarter century or so, they're also undervalued relative to US stocks, which by the same measure are a little bit more valued than they've been over the last 25 years. Continue to believe that diversification is very important. I want to spend a moment, since it's an election year, and talk a little bit about politics. Over the course of this year, since it's an election year and a presidential election year, you'll hear pretty much every day of this year, you're going to hear about something political. So I want to give a little bit of perspective on how I think about this in the investing realm and just economically speaking. The chart here, what it shows is the average percent of people who responded to a survey about rating the economy as good And it broke it out by political party for each year. So what we know from looking at this historical chart is that the economy rating gap between blue team and red team folks is the percentage saying it's good has increased since the early 2000s. So since then, how Americans assess the economy, it's become more viewed through more of a political lens than it has in the past. And in recent years, the pace at which that gap emerges has accelerated. It's a sign that we've become a little bit more of a political lens with how we look at this. So the question is, should your political opinion drive how you invest? So in my opinion, it should. Historically, there's been little to no correlation between the political party and the White House and how markets have returned. And I'll give you an example. Let's say you were a Republican when President Obama's term ended and you were strongly against his policies. If you would have not decided not to invest, if you would have done that, you would have missed out on an annualized return of 16.3%. And missing out on that return, that would be a pretty big hit for not being able to fulfill parts of your financial plan. Now, let me take the other side of that argument. Let's say you were a Democrat when President Trump went into office. You didn't like his policies, and you made the decision to not invest during his term. If you would have done this, you would have missed out on an annual return of 16%. Now, like in the previous scenario, missing out on this, it would have hurt your ability to make good on your goals and your financial plan. And when I say all that, I'm not telling you what to believe. I'm not telling you who to like or not like, but I am saying that when we choose not to invest because of political reasons, that often ends up hurting us in the long run. And just a reminder about some of the tenets that I believe are important. If financial planning is a process, not an endpoint. You need to concentrate on long-term goals and objectives, focus on reaching goals and not beating benchmarks, be disciplined in good and bad markets, invest broadly and globally and focus on asset allocation, reduce investment and tax costs where it's possible, and then rebalance over time. And just a reminder about why diversification is so important. This looks like a periodic table. Every one of these things is a different type of investment. Things change favor over time and often without warning. That's why we believe being very broadly diversified is important, not trying to guess what's going to be at the top or the bottom of this chart, but trying to be invested very broadly and over time that will benefit you and your family. And that brings us to the end. I want to thank you for joining me. I want to thank you for your attention, and I want to wish you and your family a great day and a good 2024. May God's favor smile upon you. Have a great day.